Hi, everyone. Welcome to our conversation today, checking in, talking about current trends in healthcare M&A. I am Ari Markenson. I am a partner here in the healthcare and corporate groups at Venable in our New York office. Spend my days pretty much representing both investors, lenders, and healthcare providers and healthcare suppliers in M&A and regulatory work. I only do things in the healthcare world. And I have the pleasure of talking to Jeff Woods, a partner at Bain Company today, about our topic. Jeff, why don't you give an introduction as well?
Thanks, Ari. Appreciate the opportunity here. Jeff Woods, I'm a partner in the Boston office at Bain Company. I work in our healthcare private equity group. I spend almost all of my time with private equity clients looking to invest in healthcare businesses. And specifically, I do U.S. healthcare services businesses, a lot of payer provider, healthcare IT businesses, and a little bit in the life sciences realm. 22 years in the industry and looking forward to the discussion.
Thanks, Jeff. Quickly, just as a housekeeping item, there is a Q&A feature in the webinar. We're going to take some time at the end of our conversation to take your questions and respond to them. So please, throughout the webinar, just feel free to post questions in the Q&A. And as I said, at the end of our conversation, we'll address those questions as we can. With that said, why don't we get started with our conversation? Jeff, what I'd like to do to sort of start us off is talk about issues at a high level, in the sense of give us an idea of headwinds in the healthcare marketplace, our national healthcare spend, why healthcare sort of remains attractive to investors.
Sure. We probably should fill the full 30 minutes here or longer on this one, but let me just maybe talk through a little bit about what I would characterize as an industry that still has some macro pressures that are stressing the industry, especially from a deal-making perspective. I think you have to just start with just sort of the persistent inflation we've had for the last 18 months. You've got core CPI has been stubborn, hovering just below 5%. You got 18 months of rate hikes going all the way back to March of 22, and you've got a federal funds rate now above 5%. So what I think is sort of the backdrop of all this is we've seen historically inflationary periods have been short-lived in the US, and we've been able to kind of get through these. And this one feels like there's a little bit more persistence to it, at least from that background and from the inflationary perspective. Related to that, we've seen a lot of wage increases. It's been particularly acute in the provider setting, even the hospital setting as of last year. I think they had, some reporting double-digit wage increases here. And, that's a hard way to run a business if 50% of your operating expenses are labor, and that's going up at 10%. Your revenue, your contract rates, et cetera, are not going up that much. So, at least that industry was, almost completely underwater from a profit pool perspective. And I would say a lot of that is attributed to kind of the rate of wage increases there. And then, laying on that, kind of on the flip side of that is you've got unemployment at a near 50-year low, sub 4%. So I'm not a macroeconomist, but I do know that puts us in a little bit of a weird spot in terms of just trying to slow down the economy, get inflation tamed, and not induce us into a recession here. So that is different. That's been different over the last 18 months, I think, than we've experienced in the healthcare in some time. And candidly, if you look at broadly speaking, the last 20 years, we've had falling interest rates, give or take. For that, you've also had multiple expansion on the deal side. So it's just we're in a little bit of a realm here that we haven't experienced after a very, very long, I wouldn't say golden era, but a very, very good sort of area of deal making in general. And we can get a little bit more into the healthcare and the private equity aspects of it. But we're in a little bit of an odd spot. Now, that's probably a little bit of sort of the bad news, I would say, in that, at least from a healthcare activity perspective. But in the bigger context, 30,000 view of where we are as a country with respect to our national healthcare expenditures, I'd say it's very much the same here. We had $4.3 trillion of spending, at least that's the last data point at 21, and that's forecasted to grow at 5%. That is a massive amount of resources we put in this country against healthcare, and that doesn't show any signs of slowing down. We've got Medicaid spending topped $1 trillion last year. Medicare will be there on a pathway there by 2028. 18, 19% of GDP. There's just this ballast of our healthcare expenditures that I think makes the industry very interesting. I also think I think it makes it very interesting from an investment perspective that you just have the magnitude of dollars we spend in healthcare and also the growth rate associated with it. Maybe just a little sidebar on our national healthcare expenditures, because this will probably come up. They will release the number for 2022 probably in the next quarter here. But our 2020 number for expenditure growth was actually a 60-year low, with 2.7%. We're not cracking champagne bottles and saying we figured out healthcare spending and we found a way to make the system more efficient. That number is coming off a very, very large number in 2020 of COVID of almost 10%. So there's a little bit of like seesaw here. We have a massive spend in 2020. We had a very light spend, at least from a growth rate perspective. But net, if you look at our expenditures over the last 3 years and our expenditures going forward, it's going to be in that 5 to 6% range. So I do think that's, as we think longer term about the overall context of private equity investment in healthcare, you do have that backdrop, and that backdrop feels pretty good, at least from an opportunities perspective. One other interesting note just about that expenditure in COVID in 2020, that 10% figure of our national health expenditure growth was actually buoyed by about $300 billion of federal spending. This is CARES Act. This is Operation Warp Speed, payroll protection. And so when you siphon all that stuff out and you look at what we spent in 2020, it was actually a little bit less than 2%. And the reason I cite that and even talk about that is evidence, that our healthcare system is recession resilient, not recession proof. You do have a movement with the ups and downs of the economy. Our healthcare spending, it's slight. It's about 1% change in GDP, yields roughly about a 0.5% change in our healthcare expenditures. But I do think that's important to keep in mind from an investor perspective. It's not totally immune to broader economic cycles, and it's certainly not immune to inflationary pressure. And I think a lot of folks have kind of lulled themselves into thinking that those don't apply, but for sure the inflationary side does. And to a lesser extent, I think the ups and downs of the broader economy also has an impact on our expenditures here. So net, the underlying characteristics of our healthcare spending are largely the same. And I'd love to say that we've got a step function change in efficiency, or that's going to move in a direction that may be more favorable from a societal perspective. But that's just not the case. And I think we're going to be talking about 5 to 6% growth at the macro level for some time in the foreseeable future for everything that I can see.
A couple of things to add, right? I mean, you and I had a funny conversation yesterday with saying that, just anecdotally, right, the folks that we know who are sort of the usual suspects investing in healthcare, we haven't heard from any of them in the last 15, 20 years say, I'm done, I'm out, right? I can't do this anymore. It's the ups and downs are too much for me, or it just doesn't work for me. The industry in and of itself, even with those market changes or those other things that affect the market, right, still ends up being something that people are investing in. Frankly, you've got something that makes up a third of GDP, it's going to be invested in, right? I mean, it's just that and more so, you're not going to see in the next year or two all of a sudden an industry that essentially makes up a third of GDP become a tenth of GDP, right? It's just not going to happen. And so we sort of expect that interest in healthcare, investment in healthcare, just it is going to stay, right? It's not going away, and I think we'll get to that a little bit more towards the end of our conversation again as well.
Yeah, and just on that point, I mean, one other thing, just in the backdrop of 30,000-foot view and in macro context, we've done a lot of work looking at the returns within private equity investments, returns by subsector, and even going deeper than that. But I mean, healthcare has been a fantastic place for me for the last 20 years. In particular, the last 10. We think that healthcare returns in private equity have outperformed all our industries by 500 basis points. So it's a material difference. If you didn't have allocations to healthcare, you missed out. And generally, if you looked at even the breakdown of that by geography, North America was better than the rest of the world. So this has been a good place to be. Not past performance is indicative of where we're going, but I do think that folks that have been in this industry, or at least have made investments here, are have been rewarded for it. And maybe lastly, it's just from an even greater than 30,000. If you go out, zoom way out, I mean, there are many people that advocate that our U.S. healthcare system is inefficient by many conventional metrics. It's still probably the best place to be if you're really sick. But from what we spend versus what we get out of that from an efficiency perspective, I think that's what also is very attractive from an opportunity perspective. There's just a lot more efficiency to be squeezed out of our system.
Sure. I mean, but I think that you sort of made this point just about the U.S. system in and of itself. But if you look at comparative systems, you see them from a growth perspective on the same trajectory, right? Even if you have nationalized healthcare like the NHS in the UK, if you actually graphed the growth of their cost, right, they may have started at a lower level and have stayed at a lower level, but they're on the same trajectory in terms of year-on-year growth, just like France and Germany, others are. And so I think that, while sure, it would be good for us to make the entire thing more efficient and pull some cost out. Growth in healthcare is not going away, right?
I totally agree with that. And as we've done some looks, just as you get wealthier as a country, you spend disproportionately more on healthcare. And so that's some kind of argue that's not a bad thing. I mean, you have the wealth creation, you can put it towards other things. I think where it gets where you get the argument is just to just crowd out other social goods and services, so education, things of that nature. So U.S. is an outlier beyond all outliers on any metric of benchmarking here. So that's probably wait for another time. But there is differences here, and as you said, as you get wealthier, you do spend more, and that's a predictable curve.
Yeah. Let's now try to take it closer to a bit more granular in terms of what's been going on in the healthcare M&A space as a whole, sort of, as we were coming out of the pandemic to the present, and why don't you talk a little bit about what we've been seeing? There have been some interesting sort of things happening in the M&A space in healthcare. As I said, sort of as we exited the pandemic to today.
Yeah, let me see if I've got that. Can you guys see that data at least from a deal perspective?
Yeah. Perfect.
Yeah. So this is our global buyouts for healthcare, and you can see this is a pretty good trajectory here. And I think it's just most interesting to look. I think the eyes go right to 21 and what's happening more recently. But even if you go back from 2010 to 2019-20, there was just a really nice predictable up and to the right for most of those years. You had some big deals that were pushing things up and down, but in general, the red here is the deal value, and the gray line there's the count of deals. That's on the other y-axis. So, the COVID year was interesting, but it ended up being a pretty good year, all things considered, in 2020. And it was really the 2021 when we just saw an acceleration, just a step function change in both deal value and deal in deal count. And I think that's kind of the high water benchmark that a lot of us have a reference point to. 22 was sort of a tale of two halves. In terms of the first half was actually pretty good. We weren't quite there at the 21 pace, but it was, all things we see, was a very, very healthy year. And the second half, I wouldn't say fell off a cliff, but was much materially different from an activities perspective and a dollar values perspective. So where we are today, and this is the first half of 23. This is sort of hard data to get exactly right, but you can see that annualized would be right about that $67 billion of deal value. It'll represent about a 20% decline from what we had in 22. But there's still 3 or 4 months left of the year. We'll have to sort of see how things shake out here. So we have seen a bit of a market pullback across all geographies. So this is this has been sort of down in every geography. Asia's actually held reasonably better than sort of the North America and Europe. But really, I think that this is sort of the big issue at hand of just like the deal volume coming down. I think we're going to end up looking more like we did in 2018, maybe somewhere between 2018, 17, 19, somewhere on that from a perspective of, the aggregate deals, which, back then didn't feel all that bad. But I think relative to the benchmark of 21, this feels like it's just a different time here. And, a lot factors into this. We talked about the interest rates and sort of the lending environment definitely does. Buyer-seller expectations are definitely have to come into play here as well. And I think there's some optimism here, at least in the back half of this year, that things will be better. But we've been saying that now for almost a year. So I don't think I want to call bottom, or I don't think I want to be the person with the crystal ball here. But this is at least the environment, as we said, best guess as of today, what this year is going to end up looking like.
Jeff, I wonder if you could give us a quick sense of when on the data that you've got here, I'm a not like you, but I'm somewhat of a data junkie in the sense that I sometimes look at somebody writing an article and saying that it's been a banner year for healthcare, and I look at the data that they have, and it's like, they're saying it's a banner year because Giant Pharma did $4 billion deal, and well, that doesn't make it a banner year. Where my question's going with this is, in the data that you've got here, talking about numbers of deals and dollars of deals over these years. Are we talking just healthcare services? Have you got biotech, HIT, life sciences in here? Like what is in the data that you folks are using to sort of frame out healthcare deals?
Yeah, so this is all provider deals, all payer deals. There's very few of those. The medtech is in here. Life sciences, you do have pharma, bio in here, and then the hard part is the healthcare IT, trying to separate out what is truly a healthcare IT asset versus what's just an asset, more vanilla kind of horizontal play that does have healthcare exposure. So we do curate this, and we at least try to have consistency year over year, so we can make this comparison. There's probably a little bit of puts and takes on on the margin on what's in and what's out, but we try to at least keep some consistency here to be all encompassing there. And you're absolutely right that we've seen a mix shift amongst some of those deal types as well as deal sizes. The mega deals has actually been down this year. And that does drive a lot of actually the deal volume, the differences in the red.
The other thing is, I always wonder sometimes, like, there are so many decent size, sometimes middle of the middle market or lower of the middle market, right? Deals that are essentially not primary deals, but they might be add-ons or other kinds of things where they are, they represent part of the deal marketplace, but it's very hard to actually get the data, right? To know that those things have happened and are happening. And sometimes I wonder, and it sort of may lead us into a little bit of our next conversation too, which is that a lot of the deal making that has happened more recently, right, has been very, very small add-on growth to existing portfolio companies for a lot of private equity funds. And, the likelihood, and my assumption is, you can tell me I'm wrong, but the likelihood that Bain's able to capture the fact that somebody bought, 10 two-chair dental practices over 2 months, may be quite low, right? And if we were capturing that deal volume, granted, it's not going to add 30, 40, 50% numbers to the deal volume, right? But it could potentially move the needle a little bit for us to really see what kind of deals are going on. And again, that'll probably lead us to our next piece of conversation we wanted to have anyway. But I wonder if you have any sense of kind of, what's the kind of stuff that might get missing from these overall numbers about deals and the things that we just don't have the ability to capture.
Yeah, it's a good point. We do try to exclude those add-on deals. The example you just gave, there's probably a really good one, a dental practice buying a onesie twosie. That is not included in this data. There's certain criteria, and we invested in a company called Deal Edge that basically has a proprietary database of all the private equity transactions, and they put people at work to really try to figure out what is included in, at least in these cuts here, about a true platform deal versus an add-on. Because you're right, those add-ons would skew the sort of the gray line here, particularly with a significant amount. So there is some judgment on what is and what is not, but in general, we try to at least keep that clean from a data perspective.
Yeah, no, it's mine is not a negative comment as much as sometimes we don't, we just not that we miss it, but we can't find it. Right. I mean, it's quite hard sometimes to really even get a feel for what those add-on deals are doing, even though you may have like a PPM type business, literally spend what 40, 50 million in a year, right? Or even in a quarter, adding on all these small little practice businesses or whatever it might be. But yet it's just very hard to capture that those transactions are happening.
Yep.
Anecdotally, we know they are, right? But in the data, sometimes it's hard to do that. with that said, why don't we move on to our next kind of piece of conversation that we wanted to have, which was, and I sort of alluded to it in something I just said, which was what PE sponsors are doing right now, right, with their existing investments, been a bit interesting. And there's a whole bunch of issues that are occurring. And I wonder if you could start kind of giving us a feel for, what's really happening with, the differences, frankly, that we're seeing and how PE sponsors are approaching their current investments.
Yeah, well, for one, we know that the whole period has been longer. I think it's kind of by definition, when you see this deal volume decrease a bit, that means that our PE sponsors are holding longer. We saw the exact same phenomenon in 2008, 2009, where we just saw folks holding on longer. And I think that will, effectively continue. But, do keep in mind, I think there are pressures, one of, deploying existing capital and dollars on hand. And then there's also, a little bit of pressure from what we've been hearing of, getting deals that are ready to be done, like out the door. And I think that there's just been a little bit of a pause and some hesitation here. I think that there's a little bit of optimism that those two factors will create for a little bit more activity. Now, what we have seen on the transactions that did occur, there was much less sponsor transactions. I mean, I think that's kind of the piece of the market that we've seen that has dropped most precipitously. And a lot more public to privates, a lot more carve-outs. Those two categories represented almost 80% of deal value this year. And I mean, that's markedly different than what we saw in the previous years. It's more that sponsor, more 50-60% of deal volume. That's just been totally displaced by, I'd say more different means in terms of the publics to privates and a lot of the carve-outs. But that's where we've seen the activity kick up in the absence of a lot of the sponsor work. So how long that continues, nobody knows. But as soon as that starts to kind of unlock, I think that's really when you're going to see a lot more of the deal volume and value kick up when you kind of revert back to more traditional sponsor transactions.
Interesting. Yeah, I mean, I also think that there's a couple of other things that are happening, and I don't know that I necessarily have a great answer, a great reason for them, but the length of time, right, between the beginning of a conversation between buyer and seller and actually getting a deal done, it seems to be drawn out unbelievably longer than it used to be, right? I mean, there was a lot of kinds of transactions where, LOI to close was 4 or 5 months at the most, right? Or even 2-3 months, and it does seem like folks are being way more deliberate, right? Spending more time thinking about doing a deal, talking with folks about the deal. I can't tell you how often I've had deals retraded, and I feel like they're just happening simply because people are just sitting around, right? And they're not moving the deal forward. And so everyone keeps thinking, it's like Inspector Columbo, he's got one more question kind of thing, and coming back and back and back, because folks just aren't focused on just trying to get a deal done. And I wonder if you have any thoughts as to what might be behind that. I'm seeing it, right? And I have my own thoughts about it, but I wonder if you have some thoughts about why it's sort of taking folks a long time to actually, execute.
Yeah, I think it's just one, I would just totally confirm the observation that the number of stalled processes, the length in between, hey, what do you guys know about this? And, when we actually go to being very, very serious about making a bid or pursuing an asset has definitely been drawn out. So that phenomenon for sure is confirmed. I think there's probably a piece of it that has to do with, the lending markets and when does that ease up? Probably easier, better to have one of the lenders for financings talk about just the dynamics there. But obviously, I think that's influencing some of the decision making here. But also, I feel like there's just this little bit of hesitancy, on the seller's part about, is this the right time? Is this the right marketplace to be selling into? For the assets that have traded, they've this is say pristine, but a lot of ones that have come out seem to be in kind of more marquee or very, very clean assets. that have done reasonably well in this environment. The multiple is hard to track, but it actually looks like some of the multiples that have been reasonably good. I think that's partially because only the really, really good stuff or stuff that's marketable is coming out in a good way. So I don't have a great question for when does this stall or what is causing this, but I do confirm the observation that there's been a lot of things that have just taken a long time. I just last week I had one, hey, can we revisit this? And I had to go through my emails, and it was May that we had the initial conversation. And it's like, wow, like if you look, at the time in 2018, 2019, 2020, even 2021, the first inbound about, hey, what do you got on market to, hey, we're serious. I mean, it was weeks, sometimes days, and now we're talking in months.
Yeah, it's been interesting. I mean, I think I've also heard from folks who've said, look, I'd love to give that seller X times, but when my money is Y times, I just there's no way I'm going to be able to do that. Right? I can't borrow money at those rates and still create a structure that's going to make that purchase price be at that level. I just can't do it.
Yep.
And I think that's creating some obviously some issues as well. And it's a little bit different too, in the sense that I don't, and I wonder what you think about this. I mean, even pre-pandemic, you really saw a lot of the direct lenders being able to kind of push out commercial lenders and get deals done for sponsors. And I think that dynamic has, shrunken. I won't say it hasn't gone away, right? But it has shrunken in the sense that even the direct lenders, want to get market rates as best as they can. It's what's out there, and so they're not willing to, be at an interest rate level. I mean, frankly, in some cases they can't be, right? That will allow them to finance a deal that will, make them so much more attractive than a commercial lender right now. And I think that's interesting. That's an interesting dynamic that's been going on. I also think that there's been, and it's cyclical in my mind, but because there's this weird dynamic of, if I'm going to do a deal, it has to be a really good deal, right? That folks are spending a lot of time and a lot of sort of slow walking time on diligence, right? They're not throwing everything at the wall right away, right? To look at a transaction. They're even sort of stacking them and saying, let's first do this piece of diligence. Let's do this next piece of diligence. Whereas if they really wanted a deal, if you go to pre-pandemic, if somebody really wanted a deal, they were throwing 5 different diligence avenues at somebody and saying, let's get this moving and done. And so I think that that's all kind of affecting what we're seeing. Again, doesn't mean that folks aren't doing transactions. It just means it's a very different marketplace.
Yeah, I think there was, in that frothiness of the market, maybe 2021. I mean, there was a, for better or worse, like, we're super serious, investor, like we're super serious. We've already done our diligence. We're pre-running, the process with the diligence. And we're going to do, financial diligence, commercial, regulatory, tax. I mean, they were doing that all simultaneously, like sprinting. I think there's just been less urgency. I mean, there's still in processes, there's still some compression of time, but I'd say because the deal volume is lighter, I think that there's just a little bit more, I'll say, sequencing of some of the service providers, supporting these transactions. So I agree with that whole work.
Let's now get to kind of a, look, deals are being done. I alluded to smaller deals being done. There are deals being done in biotech and life sciences by folks that necessarily didn't even play in those areas before. Why don't we talk a little bit deeper about kind of where things are happening, where they aren't happening right now?
Sure, and it's probably a good place to start with the kind of the pharma biotech. But even before we get there, I mean, where we're not seeing transactions like we normally have has really been deal volume is down kind of across the board, but it's really the absence of a lot of the provider deals, that typically make up 50%, 60% of deal volume in a given year. This is the dental, the private, the physical therapy, the urgent cares of the world, the physician practice roll-ups. That volume has come down precipitously, and I think that's been the sort of I think that's where we feel a lot of the activity, at least the drop in activity, at least from what we've seen for the last 18 months or so. Kind of offsetting that has been, probably I wouldn't say the only bright spot, but probably one of the bright spots here has been within biopharma. And a lot of that is driven by, a handful of large deals, sort of Syneos, and there's been some large transactions there. But I will say, in general, I think we've seen a much higher propensity of investors to look at life sciences deals maybe in a way that they hadn't previously. And a couple of reasons for that, but one, I think life sciences said healthcare is reasonably recession resistant. I think life sciences fits in that category, maybe even more so than the overall broader healthcare sector. But secondly, I think it's maybe go back to alluding to some of the comments earlier on returns. When we look at deal returns within healthcare, so we said healthcare is better than all other industries, but within healthcare in particular, life sciences has been kind of top of the heap. Life sciences tools and services has really been a bright spot within a otherwise really good industry. And so I think what you have is a recognition over time of, hey, having exposure to healthcare in a portfolio is important, is good, but not having any life sciences exposure has actually been, you've missed out. Again, I don't necessarily say that just because you missed out that you're going to miss out in the future, but I will wholly confirm that. I think we've seen a lot of generalist firms that may have a healthcare appetite to do investment deals have now been looking at life sciences and life sciences tools as a way to to get into the market and get more exposure there. Some of these are hard. Like sometimes some of these life sciences deals I call them healthcare heavy instead of healthcare light. I mean, these take a little bit of technical expertise and knowledge, and they're not all these deals are taking binary risk on a molecule, but some of them have dynamics that are just a little bit more nuanced than I think a lot of investors have dealt with before. But it's been a robust area, and I think it will continue to be for the foreseeable future. And generally, I've just seen a lot more allocation of portfolio into life sciences than we've seen previously.
Yeah, I mean, interesting in terms of life sciences, right? It's from an investment perspective, not for the faint of heart, in the sense that if you don't understand the science and you've not been involved in an FDA regulated business, it's a heavy lift to try and jump into buying one of those cash flow positive businesses, right? However, it's almost akin to if you've never bought into a federal healthcare program reimbursed business, right? Whole different ballgame, right?
Yeah.
A licensed business where that's taking money from the feds or the state Medicaid programs. It's just a very different ballgame. One of the things you and I mentioned the other day that we both, I think, found interesting was that you are seeing traditional healthcare players pivot to all sorts of kinds of things. So you may have a PE fund that traditionally has had a hospice business, a urgent care, and maybe a gastroenterology business, right? All of a sudden have somebody show them a patient engagement business, right? That has to do with patients who have gastro diseases, right? And that firm says, something, that fund says, I know gastro patients, right? I used to own a gastro PPM. So this kind of makes sense to me. I appreciate that it's a very different type of business, right? But I understand the disease state. I understand those patients. And I get how this company can make money off of them in terms of what they're doing, or make money off manufacturers in terms of what they're doing, depending on how their revenues are flowing, right? And you're seeing folks who are, I know of a fund that traditionally had a healthcare vertical, but also a manufacturing vertical, right? All of a sudden say, there is a niche, pharmaceutical packaging business on the marketplace. My manufacturing people, they get it, right? My healthcare people, they get it from that angle, and they went after that deal, right? And so there's I think that there's folks that are finding RCM deals, finding sort of healthcare consulting deals. I mean, there's all sort of other kinds of things that even a fund that had been solely focused on knowing what it was doing in the services space, starting to find other opportunities in other spaces of healthcare. Now, even so, doesn't necessarily mean those deals are all getting done as the same pace that they used to be getting done, but there is a lot of diversification of what folks seem to be interested in.
I totally agree with that. And, the number of times where, know the healthcare team of fund, but we're talking to the tech team on a healthcare IT deal, or even, we've seen some of the crossover even with some of the consumer teams, crossing over to healthcare as well. So I think the lines are blurred there. And I agree with you on that statement of, I think a lot of folks that were invested in provider deals, you see the GI example, we've seen that in spades with, hey, we know behavioral health, like, oh, here's a behavioral health EHR, like that, that's still a stretch, but at least you really know the underlying markets there. An urgent care business, here's an urgent care EHR, here's a data analytics platform on some of those. So I do think that's sort of almost like a natural progression of some of these teams in their investment scope as they learn in industry, at least from a provider perspective. There's a whole lot of services and technology that sits on top of that or within the ecosystem.
Yeah. I think it is interesting, and I wonder if you agree with the nuance that I'm going to point out. Which earlier you were saying that PPM deals are kind of just non-existent, and correct me, by the way, if I'm quoting you wrong, but my feeling has been that primary PPM deals just don't exist, right? There's nobody who's running out and buying a US oncology, right? They're just not, they're not on the market really. But sort of under the radar, I have seen at least a lot of folks who are almost like venture, right? Trying to onesie twosie build PPM structures in regional markets. And they're doing it like crazy, right? They're doing it on a shoestring to some extent as well, using total cash equity, not even borrowing to do some of these things, and building something that hopefully will get to be of scale, that is something that can then move up the middle market. But it's been very interesting that inbound, at least in our practice, that we've had a lot of folks who are looking, as I said, looking at just sort of cookie cuttering, finding an ology and just building something with it with very, very small transactions.
Yeah, I mean, the good news supporting that is just when you look at how fragmented all these physician specialties are, there's a ton to be had there. And I think that's right. I think there's a place in the market for folks that are willing to get back up to a world where states get their hands dirty aggregating practices to the point where they get big enough where the middle market or lower middle market, can make the investment there and take those to the next level. So I agree with that. I think it's always interesting to me to look at, something like, especially like, emergency medicine that's exceedingly consolidated, or even like dialysis, not necessarily physicians, but just dialysis. Like, how do those markets get to that industry concentration when you contrast that with others? A lot of the behavioral health, psychology, psychiatry, just have the absence of that consolidation. And, is it structurally something different, or is just someone not been in that marketplace rolling them up? The question usually depends on the specialty, but I do think that there's a role for further aggregation, especially on some of those more fragmented specialties. And I will say, maybe a little asterisk on the PPM comment, because we have seen those deals come markedly down. I think where we have seen activity in the last year, whether that's transactions or at least people really digging in, has been the value-based care aspect of PPMs. And so I almost think about the ultimate value creation lever for aggregating scale within a PPM is the ability to take on risk. I think there's very few practices that have been able to do that successfully, but I think that's kind of the next wave of PPM activity. And that's going in from everything from primary care, probably more concentrated and more bigger profile deals and things like ortho, cardio, maybe some of the renal care. That's at least where there's been activity. Whether or not those will lead to big transactions or movement, that's at least where people have been focused.
Yeah, I think what's interesting about that is that at least I'm not to say they're not as sophisticated enough, but there's a lot of folks that are doing that kind of consolidation that may have in the back of their head that taking on risk or really getting good payer relationships going forward is the right way to move that organization ahead. But it's almost like a tertiary thought, right? It's like, let's just get all these practices under our belt, grow, show that we have scale in so many states, right? And then do a bunch of other things, maybe build in some technology, make this thing a little shinier, and maybe we go figure out how to deal with payers. It's never sort of a right off the bat, let's have a payment strategy, right, with the payers.
Yeah, no, I mean, I think that jump from, hey, we're just in a scale practice and we're taking risk that's a huge leap. Where I would do that would be, I think we've seen a little bit of this of just, can you aggregate scale with primary care, or especially in an area of heavy Medicare Advantage penetration, and where you've got some payers that are probably willing to delegate that. But again, that's easier said than done.
Yeah. Look, I mean, we're seeing, it's interesting, stepping away from PPM, we are seeing like what these like almost disaggregated kind of, and it's a funny word to use, telemedicine networks of folks, are particularly around chronic care type or certain types of disease states, right? And it only works for certain things, right? Gastro is a great example, right? While yes, there are certain types of in-office procedures you have to have performed, depending on what kinds of chronic issues you may have, but generally, right, there's a lot that can be done with your gastro provider, via telemedicine, right? Same thing would go for things like, folks who need to, hang out with their rheumatologists, right? Or even, we know for a fact, right, behavioral health is a great place for it to be. And you're starting to see folks we had a lot of kind of cowboys during the pandemic try to do all these quick, telemedicine structures, and it really, they frankly have all kind of disappeared because they just weren't doing it. They were making use of waivers or other things and really not kind of doing the best that they could do in terms of structuring this stuff. But now I think you're seeing, and I know I'm seeing, right, some folks who have said, wow, this really does work in a specific way, and are putting some good dollars into it to build, even hopefully on a national scale, right? For the most part, the ones that I know of are sort of chronic condition focused, right? Telemedicine based providers that are including wellness related to the condition, physician visits related to the condition, right? Maybe even drugs and nutritional supplements related to the condition, right? In a package of services. And it'd be interesting to see how far we get with those, because most of those groups or those companies that are starting to build are starting on a total cash model, almost like a concierge model. And it'll be interesting whether or not they could really survive that way. So
yeah, and I even top that off. I mean, you've got Amazon with the Amazon Clinic. You've got Walmart that acquired a large telehealth business. It'll be kind of interesting to see how that plays out with some of those larger, exceedingly well-funded folks kind of pushing the marketplace. I know that we've had non-traditional entrants in healthcare, forever, but it seems like those two have made a big push specifically on the on-demand care, or at least, the telehealth in a way that they just haven't seen, at least from those two.
Yeah. Before we stop to take some questions at the end of our conversation, and we kind of alluded to some of this stuff anyway, but I just want to wrap up this way and sort of give a feel for we've we've talked about the good and the bad, right, in terms of what's been happening in the marketplace. But I would love to end on that note of kind of why, really, good or bad, we're just always going to see, healthcare deal making, right? It's not going away anytime soon. It's not as if next quarter everybody's just going to say we're just not doing healthcare deals, right? Give me a sense of kind of, your feeling on that.
Yeah, I mean, default historically, we've seen a lot of resiliency in the healthcare deal making market. So even through downturns, we've seen, there's a drop off in deal volume. It's not catastrophic, and it typically comes back with a vengeance, or with some bigger in the following years. So I think that historical pattern is going to hold true and will hold true here. And again, I'll cite back to the context of like our expenditures aren't getting any less. We still got the inefficiencies of the system. But I'll layer on top of that, I think there are some nuances of just the dollars on the sidelines looking to be deployed into healthcare. I mean, it's significant. It's been a really good last 2.5 years of fundraising for healthcare specific funds. So some of the kind of the healthcare focused PE funds, a lot of dollars on the sidelines. And I think that money does get deployed. And so it's that context leads me to believe that there are still deals to be had, and still a level of appetite to have healthcare deals. The other thing I think is so interesting, and maybe one of the other little bright spots for this past year has been, the response to labor inflation, right? It's like, wow, well, this is a problem in our healthcare system. This is plaguing our hospitals. Like, here's a bunch of ways to deal with that. And a lot of that is workforce management software. A lot of that's staffing businesses. You just see this pretty quick response of an issue, a problem, an inefficiency, and the market being able to respond to that and have an appetite, or at least have maybe not solutions, like things that will help alleviate some of the problems. So I do think that, as dynamic as this market is, there are pockets of opportunity that come up, depending on what day it is, what week it is, and I think that will continue for the foreseeable future. So I'm still very, very bullish on the space. So that I don't want to sort of be the guy that calling it's going to come back next month, next quarter, or first half of next year. But I do think over the longer term, this is a really good spot to be, and will continue to be so. Continue to do so. Excuse me.
Yeah, I think one of the other points that you made early on, which I don't want us to lose, right, is that, these aren't low margin investments, right? In the sense that the returns have been good for the most part in healthcare, and as a result, look, if somebody told you that healthcare investing was going to make you 0.5% a year, you would walk away probably, right? But that's simply not what we've seen over time, and folks tend to do pretty decent in doing in being in the space. So
that's all right. Yep.
So we're going to stop. See if anybody has any questions. Feel free to throw it into the Q&A. Jeff and I'd be happy to respond to questions. We'll give it a minute or two to see if folks have questions, and if not, we will let you have the rest of your day back. Jeff, anything you think before we, after we wait for seeing if anyone wants to raise anything you think that worth adding to the conversation that maybe we didn't spend a lot of time talking about?
It would cover, at least from a deal perspective. We didn't touch on the healthcare. IT's been a pretty big component of healthcare deal flow. And the onset of AI has just been really, I would say, top of mind for a lot of the investors. Not only like, how can I either invest in this technology, but probably even more so the activity of just how does this impact, or has potential to impact, a portfolio company or potential investment. Are we seeing everything we need to see on the horizon here? It's a little hard to say, like, this is this feels like this is going to be materially impacted, or it could be to the detriment of a company. But at least folks have been proactive about trying to screen and think through how does this new technology apply to an existing asset, or potentially an investment theme that they're thinking about. So again, not something that I think is materially impacting deal volumes or activity, at least at the moment. But obviously, I would say it's top of mind for a lot of our investors here. And I think it's going to be ubiquitously impacting healthcare. I think it's going to be a little bit concentrated in certain areas. We're going to see it. Certainly in data analytics and rev cycle businesses, I think that's where we're going to see it first. But I do think it has larger applications across almost the entirety of the healthcare spectrum.
Yeah, interestingly, and I'd make one other observation that's more from the lawyer in me, right? And that I have seen, as folks have tried to think about lots of different things that they can do in healthcare, there are entrepreneurs, I'll say, coming from different angles, right, at different things in healthcare, and frankly, not really recognizing where they may or may not be regulated in what they're doing, right? I'll give you a perfect example, right? You create an app on your phone that asks, the user in the morning, hey, how are you feeling? And has some little, smiley faces, sad faces, and you choose one. And it says, sounds like you're not feeling great. Why don't you go play this puzzle kind of thing or read this poem or whatever it might be, right? Well, that's really not diagnostic, right? It's not something that's going to get regulated. But if that app said, sounds like you're depressed, you start to fall into a very heavy regulated atmosphere, right? And as we have, and by the way, this has been accelerated a lot by virtue of the pandemic and folks thinking about how much more technology they can use to address certain things in healthcare. I think you're finding that, and I found this too with, for example, venture funds or other funds that typically haven't been healthcare investors, right? Looking at products and not recognizing that they're not just investing in some app, right? Or they're not just investing in some, something that is, that doesn't otherwise have some very serious regulatory implications to it. A business that's focused on wellness and selling supplements that have their own FDA regulatory issues, right? But yet also is, looking to provide you with what they might call, wellness coaching, but yet is a nurse or a nurse practitioner talking to you about how to use those supplements, right? And there's regulatory issues that get pulled up by that kind of a thing. And so I think that there's some interesting things happening in the changes in the healthcare system and industry that we're seeing, where there are additional kind of holes folks can step in if they're not really paying attention to what those things are. And as folks try to invest in other things that aren't their traditional investment thesis, right? Some folks are so attuned to health regulatory issues that they just, they can't believe that there aren't any, right? But others are not attuned to it, and they end up with looking at businesses that need to be vetted in a certain way. And I think that's an interesting dynamic that I've seen a lot more lately, as we just try to use what we know about just wellness, primary care, even things outside of traditional medicine, right? And mirror and sort of merge them with what we're doing otherwise. Folks just don't realize that there are, again, regulatory issues that can come up. Any other parting words, Jeff? Otherwise, it doesn't seem like we're getting many questions, which is fine with me at this point, and we'll sign off. But if you've got any other parting words, I'll give it to you, and then we'll say thank you to everybody.
No, I appreciate the opportunity. It's a great discussion, and thank you for having me.
Jeff, thanks so much for joining me. I really appreciate it. We all appreciate it. Thanks for anyone listening in. This will also, it's being recorded and it'll be posted, and folks will be able to take a listen to it when they feel like it. And again, thanks so much, and have a good rest of your day. Take care.